The most convincing investment advice online no longer sounds suspicious. It sounds calm, confident, familiar. Faces look real. Voices feel authentic. Charts move smoothly across the screen. Nothing appears rushed or exaggerated. That is precisely what makes it dangerous. A quiet shift has taken place. Technology that once required expertise is now accessible, fast, and cheap. Images can be generated. Voices can be cloned. Entire personalities can be simulated with unsettling accuracy. In finance, where trust already carries weight, this shift has changed the rules without announcing itself. What makes this moment different from past scams is not scale alone, but realism. False advice no longer relies on obvious manipulation. It relies on credibility. The language is measured. The presentation looks professional. The message feels tailored rather than generic. Doubt is disarmed before it has time to form. The risk is not that people believe everything they see. It is that the boundary between authentic and artificial has blurred enough to make skepticism exhausting. When every signal can be forged, discernment becomes harder to sustain. Attention is overloaded. Familiar cues no longer guarantee legitimacy. This environment rewards speed and confidence, not verification. Content spreads faster than scrutiny. Authority is borrowed through likeness rather than earned through track record. The result is a landscape where appearance can precede truth convincingly enough to influence real decisions. Understanding how this happened matters, but understanding how it operates now matters more. Because the threat is no longer obvious deception, it is believable imitation. And in finance, believable imitation is often enough. To understand why fake investment advice has become so effective, it helps to look at how trust is now manufactured online. In the past, credibility was built slowly through reputation, institutional backing, or long public records. Today, credibility can be assembled visually in minutes. A familiar face, a confident tone, and a polished presentation are often enough to bypass skepticism. Artificial intelligence has compressed the distance between imitation and authenticity. Faces can be synthesized to resemble well-known investors. Voices can be cloned from short audio samples. Scripts can be generated to sound measured, thoughtful, and reassuring. None of this requires deep technical skill anymore. It requires access, not expertise. Social platforms accelerate this effect. On YouTube, TikTok, and Instagram, algorithms reward engagement, not accuracy. Content that looks authoritative travels further than content that is careful. Visual confidence outperforms nuance. This creates an environment where realism matters more than verification. What makes AI-driven misinformation especially dangerous is that it does not need to invent new stories. It repackages familiar ones. Long-term investing, market cycles, safe opportunities. The language often mirrors legitimate financial education. The deception lies not in what is said, but in who appears to be saying it. Deepfakes exploit pattern recognition. Humans are wired to trust faces and voices. When those cues are present, analytical defenses soften. The brain shifts from evaluation to reception. This shift happens automatically, before logic intervenes. AI systems are designed to exploit this gap precisely. Another factor is repetition. The same message appears across multiple accounts, formats, and platforms. This creates artificial consensus. When similar advice appears everywhere, it begins to feel validated by volume. Familiarity replaces verification. The advice feels less risky simply because it is seen often. The financial context amplifies this vulnerability. Markets are uncertain by nature. People search for clarity during volatility. When uncertainty rises, the demand for confident explanations increases. AI-generated advice fills that demand efficiently, offering certainty where none exists. What is most unsettling is how little obvious fraud is required. No spelling errors, no unrealistic promises, no urgent language. Many fake advisors present themselves as cautious, long-term thinkers. They warn against risk, even as they quietly redirect trust toward manipulated outcomes. This shift has changed the nature of financial skepticism. In the past, Skepticism meant avoiding offers that looked too good to be true. Now, it requires questioning things that look entirely reasonable. This is a higher cognitive burden, and it is not evenly distributed. Fatigue sets in. AI does not need to persuade everyone. It only needs to persuade a small fraction consistently. When content is cheap to produce and endlessly scalable, even low conversion rates become effective. The result is a steady background erosion of trust rather than isolated incidents. The danger is not that fake advice overwhelms legitimate voices completely. It is that it blends into them closely enough to confuse boundaries. When imitation is good enough, doubt spreads indiscriminately. People begin to distrust everything, including credible sources. This erosion has consequences beyond individual losses. It weakens the overall information environment. When trust collapses broadly, rational decision-making becomes harder. People retreat to instinct, tribal cues, or emotional signals. These are precisely the conditions under which manipulation thrives. The rise of AI-driven financial misinformation is therefore not just a technical issue, it is a structural one. It reshapes how authority is perceived and how quickly it can be fabricated. The tools do not create deception on their own. They accelerate it beyond the pace of human verification. Understanding this shift is essential because avoiding fake investment advice is no longer about spotting obvious red flags. It is about recognizing how convincingly those flags can now be hidden. The challenge ahead is not learning to distrust everything, but learning where trust must now be earned again. The challenge with fake investment advice is not simply that it exists, but that it increasingly avoids the cues people were trained to rely on. For years, fraud education focused on obvious signals, exaggerated promises, urgent calls to act, grammatical errors, or amateur visuals. AI-driven misinformation has learned from those lessons. It now hides behind restraint. This restraint is intentional. Calm language reduces suspicion. Long-term framing feels responsible. Warnings about risk sound mature. The advice often appears conservative rather than opportunistic. This tone disarms critical thinking because it mirrors how legitimate financial education is usually presented. The problem is that humans rely heavily on surface cues when processing information quickly. Facial expressions, vocal cadence, and visual polish act as shortcuts for credibility. AI systems are optimized to reproduce these cues convincingly. When those shortcuts are triggered, deeper analysis is delayed or abandoned. This is where the illusion becomes effective. The content does not need to be true. It only needs to feel familiar. Familiarity creates comfort. Comfort lowers resistance. The advice slips past scrutiny not because it is persuasive, but because it feels ordinary. Another layer of deception lies in specificity. Fake advice often references real market events, uses accurate terminology, and cites genuine concerns. This creates a halo effect. When some details are correct, the entire message feels reliable. The false elements are carried along unnoticed. AI systems excel at this blending. They can stitch together fragments of real analysis into coherent narratives that appear thoughtful but lack accountability. There is no underlying track record, no history of past decisions to evaluate. The message exists in isolation, detached from consequence. This detachment matters because accountability is what distinguishes guidance from performance. Real investors carry visible histories. Their ideas can be traced, compared, and challenged over time. AI-generated personas have no past to interrogate. They exist only in the present moment, optimized for persuasion rather than consistency. Another danger is the erosion of skepticism through repetition. When similar advice appears across multiple videos, accounts, or formats, it begins to feel validated. The brain interprets repetition as confirmation. This is not rational evaluation. It is cognitive efficiency at work. The result is a subtle normalization of unverified authority. People stop asking who is speaking and start focusing only on what is being said. This shift is critical. In finance, who speaks matters as much as the content itself, because incentives shape advice. AI-generated content has no incentives in the human sense. It does not bear risk. It does not experience loss. it does not suffer reputational damage. It can recommend anything without consequence. This absence of consequence is what makes imitation dangerous. Another overlooked factor is emotional timing. Fake advice often appears during periods of uncertainty or volatility. When markets are calm, skepticism is easier to maintain. When markets are unsettled, clarity is sought urgently. AI fills that demand instantly. This urgency narrows attention. People are less likely to verify sources when they feel behind or anxious. The advice does not need to promise extraordinary returns. It only needs to offer relief from uncertainty. That relief is often enough to influence decisions. The realism of modern deepfakes also creates a new problem: false negatives. People assume that if something looks fake, they can dismiss it. But high-quality AI content looks real. The absence of obvious flaws becomes a misleading signal of legitimacy. This shifts the burden of proof unfairly. Instead of assuming content is trustworthy until proven otherwise, people must now assume neutrality until credibility is established independently. This is cognitively demanding. It requires slowing down in environments designed for speed. The danger is compounded by platform design. Short-form video formats compress complex ideas into persuasive snippets. Context disappears. Nuance is stripped away. Confidence remains. AI thrives in this environment because it can generate endless variations without fatigue. Over time, this leads to a form of trust exhaustion. When people encounter too much ambiguous content, they either disengage entirely or lower their standards. Both outcomes increase vulnerability. Disengagement leads to apathy. Lowered standards invite manipulation. This is why recognizing fake advice is no longer about spotting lies. It is about understanding structure. Who benefits if the advice is followed? What happens if it fails? Where accountability resides? These questions cannot be answered by visuals alone. The most effective defense begins with reframing skepticism. Skepticism is not cynicism. It is not disbelief. It is a pause, a refusal to act until context is restored. AI-generated advice relies on momentum. Breaking that momentum is often enough to weaken its influence. Another important shift is recognizing that authenticity can no longer be inferred from appearance. A familiar face does not guarantee legitimacy. A calm voice does not imply experience. Professional visuals do not indicate accountability. These cues have been decoupled from truth. This does not mean rejecting all online financial education. It means changing how credibility is assigned. Track record matters more than presentation. Transparency matters more than polish. Consistency over time matters more than clarity in a single moment. The deeper issue is that AI has made persuasion cheap. When persuasion is cheap, it becomes abundant. When it becomes abundant, its value declines. Discernment becomes the scarce resource. Avoiding fake advice is less about identifying bad actors and more about protecting attention. Attention is where decisions begin. When attention is captured too easily, decisions follow too quickly. AI exploits this sequence by optimizing for engagement rather than understanding. Slowing the sequence disrupts the mechanism. This chapter reveals why fake investment advice feels harder to avoid than past scams. It is not louder. It is quieter. It does not rush. It reassures. It blends in. That is its strength. Recognizing this changes the task. The goal is not to outsmart AI. It is to refuse to let speed replace verification. When decisions are delayed just enough to reintroduce context, the illusion loses much of its power. The line between real and artificial advice will continue to blur. That is unlikely to reverse. The question is not whether AI will become more convincing, but whether habits of discernment can become stronger. Avoiding fake investment advice in this environment is no longer about spotting tricks. It is about restoring friction where technology has removed it. And that friction begins with slowing down before believing. Once realism replaces obvious deception, the problem shifts from detection to process. Avoiding fake investment advice is no longer about spotting what is wrong on the screen. It is about what happens before and after the screen. The defense moves away from visual judgment and toward verification habits that are deliberately slower than the content. Trying to persuade. The most important shift is recognizing that advice does not exist in isolation. Real guidance is anchored to a body of work. It has a history that can be examined, challenged, and compared over time. Fake advice, no matter how polished, floats without this anchor. It appears fully formed, confident, and self-contained. That self-containment is not a strength. It is a warning. Verification begins with context. Where does the advice live beyond the clip or post? Is there a long record of similar thinking expressed consistently? Or does the message stand alone? Authentic financial reasoning tends to evolve gradually. It shows uncertainty, revision, and continuity. Synthetic advice often appears complete and settled because it does not need to reconcile with the past. Another critical habit is separating explanation from instruction. Many fake advisors avoid explicit recommendations. Instead, they frame narratives that gently steer attention toward a conclusion without stating it outright. This indirectness feels sophisticated. It also avoids accountability. Real advice, even when cautious, eventually clarifies assumptions and trade-offs. Accountability is the core differentiator. Human advisors operate under reputational constraints. Their past statements can be revisited. Their mistakes can be surfaced. AI-generated personas cannot be embarrassed or corrected. They disappear and reappear without consequence. Verification therefore requires asking who absorbs the cost if the advice is wrong. This question often has no clear answer in fake content. There is no disclosure of incentives, no explanation of positioning, no acknowledgement of downside beyond generic warnings. The absence of specificity about consequence is itself informative. Real financial thinking is shaped by exposure to loss. It leaves traces. Another defensive shift involves resisting urgency, even when none is stated explicitly. Fake advice does not always push for immediate action. Instead, it creates a sense that inaction is passive risk, that markets are moving, that others are already positioned. This ambient pressure accelerates decision-making quietly. Slowing this process is essential. Verification is not a checklist completed quickly. It is a pause long enough for external confirmation to enter, searching for independent sources, comparing viewpoints, looking for disagreement. Legitimate ideas usually generate debate. Synthetic ones often exist in echo chambers. This is where platform dynamics matter. Algorithms cluster similar content together, reinforcing impressions. Verification requires stepping outside that cluster intentionally, looking for dissent, looking for long-form analysis rather than short-form persuasion. The absence of dissent is not reassurance. It is often a sign of artificial amplification. Another overlooked habit is delaying commitment. Fake advice is optimized for immediate influence. It aims to shape perception quickly. Real understanding develops slowly. When decisions are postponed, the emotional charge fades. What remains is the underlying logic, which is often thin. This delay also allows contradictions to surface. Inconsistent claims become visible over time. Synthetic personas may contradict themselves across outputs without memory. Humans with real track records rarely do so without explanation. Time is an effective filter. The environment makes this difficult because speed is rewarded. Content flows continuously. New signals replace old ones rapidly. Verification feels inefficient. Yet inefficiency is precisely what protects against manipulation. Friction is not a flaw. It is a safeguard. Another important adjustment is recognizing that expertise cannot be inferred from presentation. Production quality is no longer expensive. Fluency can be generated. Authority must be earned through transparency rather than aesthetics. This means privileging sources that explain limitations as clearly as conclusions. Real financial thinking includes uncertainty. It acknowledges what is not known. It frames probabilities rather than certainties. Fake advice often presents clarity without cost. It resolves ambiguity smoothly. That smoothness should prompt caution rather than relief. The most resilient approach is to treat online advice as hypothesis rather than instruction. Hypotheses invite testing. Instruction invites compliance. This mental framing reduces emotional engagement. It restores agency. Avoiding fake advice does not require technical expertise in AI. It requires disciplined skepticism applied consistently. The same skepticism used in evaluating businesses or markets can be applied to information itself. Who benefits? What assumptions are embedded? What happens if the premise fails? These questions slow the process enough to expose weaknesses. They do not need to be answered perfectly. They only need to be asked. The rise of AI has shifted the burden of discernment onto the audience. That burden cannot be outsourced to appearance or tone anymore. It must be carried deliberately. This is uncomfortable, but unavoidable. The goal is not to distrust everything. It is to rebuild trust on firmer foundations. Foundations that cannot be fabricated quickly. Time, consistency, accountability, and consequence. When these foundations are absent, the safest response is not rejection, but delay. Delay deprives fake advice of its primary advantage, speed. In an environment where persuasion is instant, patience becomes protection. As verification habits mature, attention shifts to a quieter but more revealing dimension of fake investment advice: incentives. Advice does not exist in a vacuum. It is shaped by who benefits when it is followed. In the AI era, this question matters more than ever because incentives can now be hidden behind convincing presentation. Traditional financial advice carried visible incentives. Commissions, fees, affiliations, and disclosures were imperfect, but legible. Even when conflicts existed, they left traces. AI-generated advice often removes those traces entirely. The message appears neutral, educational, and detached from outcome. That neutrality is rarely real. Incentives do not disappear simply because they are not disclosed. They are displaced. The benefit may flow to an affiliate link, a data harvesting funnel, a platform engagement metric, or a future manipulation that is not yet visible. The advice itself becomes a gateway rather than an endpoint. This is why asking, who benefits if this advice is followed, is more informative than asking whether the advice sounds reasonable. Reasonable advice can still be strategically framed. Incentives shape framing subtly. They influence what is emphasized, what is omitted, and what risks are minimized. AI systems are particularly effective at optimizing this framing. They can present balanced language while quietly steering attention toward actions that serve an external objective. The absence of explicit instruction does not imply absence of direction. Direction can be implied through narrative structure alone. Another complication is that incentives can be deferred. The advice may not push for immediate action. It may build trust gradually. It may position itself as a long-term guide. This delayed strategy mirrors legitimate education, making differentiation harder. The incentive reveals itself only later, when trust has already been established. Long-term observers note that authentic financial guidance tends to surface trade-offs clearly. It discusses what could go wrong, not just what could go right. Incentive-driven content often treats downside abstractly while presenting upside concretely. This asymmetry is subtle but telling. Another indicator lies in specificity of accountability. Real advisors explain where responsibility lies. They clarify what is being assumed and what is uncertain. Incentive-driven AI content often avoids this specificity. It speaks in generalities that cannot be falsified. When outcomes disappoint, there is no clear point of responsibility. This lack of accountability is not accidental. AI personas cannot be held to account in the way humans can. They do not accumulate reputational cost. They do not face professional consequences. Their incentives are external, and their identities are disposable. This disposability changes the risk calculus fundamentally. Understanding incentives also requires recognizing platform economics. Content is rewarded for attention, not accuracy. Even advice that does not directly monetize a trade can monetize engagement. View time, clicks, and shares all convert into value. This creates an incentive to sound confident and complete rather than cautious and conditional. The problem is not that monetization exists. It is that monetization is obscured. When incentives are hidden, audiences cannot adjust trust appropriately. In finance, where decisions have long-term consequences, this asymmetry is dangerous. Another overlooked aspect is how incentives shape repetition. Messages that perform well are repeated, refined, and amplified. Over time, they feel authoritative simply because they persist. This persistence is not evidence of validity, it is evidence of optimization. Avoiding fake advice therefore requires tracing incentives backward, not to expose wrongdoing necessarily, but to understand alignment. When incentives align with long-term accuracy and accountability, advice tends to improve over time. When incentives align with engagement alone, advice tends to drift toward persuasion. This distinction reframes skepticism. The goal is not to accuse content of deception, it is to locate where incentives point. Advice that benefits the speaker regardless of outcome should be treated differently from advice that carries visible cost if wrong. The AI era has made this analysis essential because the speaker may not exist in any meaningful sense. The persona is a vehicle. Incentives live elsewhere. Following the trail requires patience and context, not technical detection. Another protective habit is separating learning from acting. Information can be consumed without commitment. Advice becomes dangerous when it triggers immediate behavior. Maintaining distance between understanding and action reduces the leverage of incentives. This distance also exposes inconsistencies. Over time, incentive-driven content reveals its priorities through what it returns to repeatedly. Certain themes are emphasized. Certain conclusions recur. The pattern becomes visible when attention is sustained without compliance. The uncomfortable truth is that no tool can automate this discernment fully. Incentive analysis is a human task. It requires judgment, context, and tolerance for ambiguity. AI makes persuasion efficient, but it does not eliminate the need for responsibility on the receiving end. In a sense, fake investment advice exploits a gap between persuasion and accountability. The defense is not perfect detection, but alignment awareness. When incentives are understood, the persuasive power of presentation diminishes. This chapter marks a turning point. Avoiding fake advice is no longer about identifying what is false. It is about understanding what is motivated. Motivation leaves fewer disguises than content itself. When incentives are unclear, the safest response is not outrage or dismissal. It is restraint. The decision to wait until alignment is visible protects more effectively than any technical filter. In finance, as in markets, incentives shape behavior more reliably than intentions. Recognizing that truth is one of the most durable defenses available in an environment where appearances can be fabricated at will. By this stage, the problem is no longer identifying individual pieces of fake advice. It is managing exposure to an environment where persuasion is constant. The most effective defense is not technical detection or perfect skepticism. It is the deliberate reintroduction of slowness into a system designed for speed. Speed is the core advantage of AI-driven misinformation. Content appears instantly, adapts quickly, and responds to trends faster than human verification can follow. The goal is not to convince through argument, but to influence through immediacy. Decisions made quickly are easier to steer. Slowness interrupts this advantage. When decisions are delayed, emotional intensity fades. Urgency dissolves. What remains is the underlying logic, which often proves insufficient when separated from presentation. This is why many fake investment narratives collapse when revisited days later rather than minutes later. Long-term observers emphasize that most financial mistakes are not caused by lack of intelligence, but by compressed decision windows. AI thrives in compressed windows. It creates the illusion that waiting is costly. In reality, waiting is often the most protective action available. This is not about inaction, it is about sequencing. Information is allowed to arrive first. Action is allowed to arrive later, if at all. The gap between the two is where discernment operates. Without that gap, persuasion becomes default. Another critical element of slowness is format choice. Short-form content optimizes for impact, not accuracy. Long-form analysis optimizes for coherence. Fake advice can survive in short bursts. It struggles under sustained examination. Reading, listening, and watching for longer periods exposes contradictions and vagueness that quick clips conceal. This does not require consuming more content. It requires consuming less, but deeper, fewer sources, more context. Repetition is replaced by comparison. Agreement is replaced by tension. This shift reduces susceptibility to manufactured consensus. There is also a psychological component to slowness. It restores agency. When attention is constantly captured, agency erodes. People react rather than decide. Slowing down returns control to the individual. Control reduces vulnerability because manipulation relies on momentum. Another overlooked benefit of slowness is memory. AI-generated advice often lacks continuity. Messages are optimized for the present moment, not for consistency over time. When content is revisited later, it may conflict with earlier outputs. Human advisors, by contrast, must reconcile their past statements with present ones. This reconciliation leaves a trail. Allowing time between exposure and evaluation makes this trail visible. It reveals whether ideas evolve coherently or simply reset. Consistency over time is difficult to fabricate convincingly at scale. Time exposes the difference. Slowness also changes how uncertainty is tolerated. Fake advice often offers resolution. It explains what is happening and what to do. This resolution is comforting, especially during volatile markets. Real analysis rarely resolves uncertainty completely. It frames it. Choosing slowness means accepting unresolved questions. It means resisting the urge to replace uncertainty with certainty prematurely. This is uncomfortable, but it is honest. Markets themselves do not resolve uncertainty quickly. Expecting advice to do so is unrealistic. The habit of slowing down also interacts with incentives. Content designed to monetize engagement loses leverage when engagement is reduced intentionally. Watching less, clicking less, sharing less. These choices weaken the feedback loops that amplify manipulation. This is not withdrawal from information. It is selectivity. Attention becomes scarce again. Scarcity restores value. When attention is valuable, it is protected more carefully. AI thrives on abundance. Slowness reintroduces scarcity. Another protective effect is emotional regulation. Many fake investment narratives exploit emotional states: fear of missing out, fear of loss, desire for control. Slowing down dampens these states. Emotions are time-sensitive. They peak and fade. Decisions made after the peak are usually better. This emotional cooling-off period is not a technique. It is a consequence of patience. When the nervous system settles, reasoning improves. AI content cannot adapt to this because it relies on initial impact. Its influence decays with time. Slowness also encourages cross-checking. Naturally, when decisions are not rushed, there is room to seek alternative views. Disagreement surfaces. No single narrative dominates. This pluralism is uncomfortable but protective. It is important to note that slowness does not guarantee correctness. Mistakes will still occur. The goal is not perfection. It is risk reduction. Slowness reduces the likelihood of irreversible decisions made under artificial pressure. In the context of AI and deepfakes, this matters because the technology will continue to improve. Visual cues will become indistinguishable. Voices will become flawless. Detection tools will lag. Slowness does not depend on technical detection. It depends on behavior. This behavioral defense scales personally. It does not require collective regulation or platform reform to be effective at the individual level. While systemic solutions matter, slowness is immediately available. Another subtle advantage of slowness is how it reframes learning. Instead of chasing answers, it prioritizes understanding. Understanding takes time. It resists simplification. AI-generated advice often simplifies aggressively because simplification persuades more easily. When learning is valued over answers, persuasion loses power. The audience becomes harder to move because movement requires conviction rather than impulse. This is the opposite of what fake advice seeks. The environment will continue to reward speed externally. Internally, choosing slowness is a form of independence. It separates the pace of decision-making from the pace of information flow. This separation is where safety lives. The sixth chapter of this discussion resolves here. Avoiding fake investment advice in the AI era is not about becoming a detective. It is about becoming slower than the systems trying to persuade. Speed is their advantage. Time is yours. When time is reclaimed, the illusion weakens. Decisions regain weight. Advice becomes something to examine rather than absorb. In a landscape optimized for immediacy, patience is not passive. It is protective. At the end of this discussion, one reality becomes unavoidable. The line between real and artificial advice will continue to blur. Faces will become more convincing, voices more familiar, arguments more polished. The problem is not that this will happen, but that it already has. The question is no longer how to stop it, but how to live intelligently within it. Avoiding fake investment advice in this environment is not a technical challenge. It is a behavioral one. Technology has accelerated persuasion faster than it has accelerated judgment. That gap will not close automatically. It must be managed deliberately. The most important shift is recognizing that certainty has become cheap. Confidence can be generated. Authority can be simulated. Clarity can be manufactured. What remains expensive is accountability. Accountability still requires time, exposure to consequence, and consistency across changing conditions. These qualities cannot be generated instantly. This reframes how trust must be built going forward. Trust can no longer be granted based on appearance, fluency, or familiarity. It must be earned through continuity, through ideas that survive scrutiny, through reasoning that holds when revisited, through transparency about incentives and limits. The danger of AI-driven misinformation is not that it will fool everyone. It is that it will normalize shallow trust. When trust becomes shallow, decisions become fragile. Fragile decisions fail not only financially, but psychologically. They erode confidence in one's ability to judge reality. The antidote is not suspicion of everything. That leads to paralysis. The antidote is selective trust grounded in process rather than presentation. Trust that is conditional, revisable, and slow to form. This kind of trust is resilient because it does not depend on being right immediately. Financial decisions have always rewarded those who can tolerate uncertainty longer than others. In the AI era, this tolerance extends beyond markets into information itself. The ability to wait, to cross-check, and to revisit ideas over time becomes a competitive advantage. This advantage is quiet. It does not announce itself. It does not trend. It does not feel urgent. Yet it protects against the most costly errors precisely because it resists urgency. Fake advice relies on momentum. When momentum is denied, its power diminishes rapidly. Another important realization is that technology does not eliminate responsibility. It redistributes it. As tools become more powerful, the burden of judgment shifts toward the individual. This is uncomfortable, but it is also clarifying. There is no shortcut to discernment anymore. The goal, then, is not to become immune to manipulation, but to reduce exposure to it meaningfully. Fewer sources, deeper engagement, longer time horizons. These choices do not eliminate risk. They make risk manageable. Over time, different relationship with information emerges. Advice becomes something to examine rather than consume. Opinions become inputs rather than instructions. Confidence is replaced by curiosity. This shift changes how influence operates. In such an environment, fake advice loses its primary advantage. It can still appear, it can still persuade briefly, but it struggles to endure. It cannot survive repeated questioning. It cannot build a record. It cannot absorb accountability. What remains after the noise settles is structure, habits that slow decisions, frameworks that prioritize incentives and track record, a willingness to sit with uncertainty rather than resolve it prematurely. These are not technological defenses. They are human ones. This is the quiet conclusion of the AI and deepfake problem in finance. The solution is not perfect detection. It is imperfect patience applied consistently. It is the refusal to outsource judgment to appearances, no matter how convincing. As technology improves, this refusal will matter more, not less. The more persuasive the surface becomes, the more valuable depth becomes, the more abundant information becomes, the more valuable attention becomes. In the end, avoiding fake investment advice is not about winning a battle against AI. It is about preserving something older and more fragile, the ability to think slowly in a fast world. That ability does not make decisions flawless, it makes them durable. And in finance, durability has always mattered more than speed.